It's one thing to hire a fee-only fiduciary advisor on a one-time basis to come up with an investing game plan if you need help, but it's another thing to constantly pay someone quarter after quarter, year after year to hold your hand while you invest. One of my favorite quotes is, if your advisor thinks that he can pick winning stocks, choose winning actively managed mutual funds or time the market, steer clear. So are you one of these people who thinks that it's the job of Mr. Advisor to attempt to time market ups and downs, getting you out of stocks before a stock market crash or as a stock market crash is starting to unfold? Or do you look for an advisor who has a good track record of picking winning individual stocks and individual bonds, or picking winning actively managed mutual funds instead of plain old index funds, which simply copy an index like the S&P 500 index? Well, I can tell you that Vanguard does not recognize market timing or the picking of individual stocks and bonds as anything that advisors do to create value as advisors. According to Vanguard, you invest in broadly diversified index funds and you rebalance if and when your bond stock allocation ratio becomes imbalanced. And I can tell you that all of the robo-advisors out there that I've seen also recommend index funds. Accordingly, you should never pay any asset manager to constantly hold your hand and bill you year after year. And you should never pay or work with some broker or other market guru either to handpick individual stocks and bonds for you, or to even select a wide array of index funds, because investing is simple. All you do is invest in as little as 2 index funds, a total bond market index fund and a broad market stock index fund that tracks the S&P 500 index or the total stock market index. Then you simply percentage rebalance to maintain the allocation ratio that you previously decided on if and when your allocation ratio becomes imbalanced. Incredibly simple, doesn't require day-to-day monitoring, head-scratching analysis of company financials or the state of the economy in general. It doesn't require expertise in anything. But yet there's tons of investors out there who think that investing is complicated, and asset managers certainly aren't going to enlighten you otherwise. They want your business. Annuity salesmen certainly aren't going to enlighten you on how simple investing is either. For example, I got a response from an insurance salesman recently who was posing as a consumer, presenting the straw man argument that you're supposed to invest in individual stocks and individual bonds instead of a couple of index funds, and therefore it's too complicated. I'm not a stock market expert. I'm not a bond expert. I don't know how to manage my money. Therefore, I invested in annuities and index universal life insurance. And the irony of what he's saying, consumers certainly don't understand index annuities or index universal life insurance. Nobody understands these incredibly complex products. You have to be a mathematician with spreadsheet software and historical data to enter in to even begin to figure out what kind of lowly returns you're going to get with these products. So this guy who posted this response to my video is a clown. But so let's say you've got $500,000 that you have to invest. Are you actually going to pay 1%, $5,000 per year to some asset manager? But by the way, I can never understand why these guys charge based on assets under management. Shouldn't it be based on how many hours they spend working with you, regardless of your net worth? It should take about the same amount of time to work with client A, who has $100,000, versus client B, who has $1 million in his account. Would you pay a contractor 5 or 10 times as much to build the exact same room addition just because you're 10 times wealthier? That makes no sense. But putting that aside, some people will say, well, my advisor, he helps me with other things like estate planning. Estate planning? You hire a lawyer to do that. Get a living trust. And if there's anything financial to discuss, it should be on a one-time basis. You shouldn't be billed year after year for that. Or some people will say, well, my advisor, he helps me with tax planning. I have tax questions. And that's what your tax accountant is for. Don't have an accountant? Well, you can talk to a tax expert on sites like justanswer.com for $39 for 15 minutes instead of $5,000. But really, the number one misconception that people have about advisors is that Mr. Advisor can time market ups and downs. If we have another 2008 market crash, then Mr. Advisor is going to read the writing on the wall and pull my money to safety. And this is just plain nonsense. Nobody has psychic abilities to foresee if a decline of 5%, 10%, 20%, 30%, 40%, or 50% will lead to even more decline. Nobody knows. Now, there's lots of money managers out there who are constantly guessing, and like a broken clock, sooner or later they're bound to be right on one of their guesses. But they're Texas sharpshooters. Market declines don't come with advance warning, and the markets are always fairly valued based on all information that is available. It's called the efficient market hypothesis. Anyone who says otherwise is talking out of their posterior region. They don't know. By the way, there's lots of people out there who are very, very knowledgeable about the markets, the inner workings of macroeconomy, company analysis, reading charts, head and shoulder patterns, technical analysis, etc. And they impress people with this knowledge. And they've got certifications like Certified Financial Planner, and they've been in the financial services business for 10, 20, 30, 40 years. But again, all this doesn't matter. Nobody can predict the direction of the stock and bond markets. So don't ever pay someone thinking that they're going to get you out of the market in advance of the stock markets going down and then get you back in at a lower price. You're more likely to simply miss out on gains if you attempt to time the market. Really, the only way you can beat the market is by simply taking on more risk and then hopefully getting lucky. But anybody can take more risk. There's no skill involved in taking on more risk. Same goes with stock picking abilities and mutual fund picking abilities. Big-time Wall Street mutual fund managers underperform their benchmarks after fees. Jim Cramer's picks are neither good nor bad, so why would the advisor down the street have magical stock picking abilities? Or why would some broker or some research guys at a big brokerage firm have magical stock picking abilities? You're throwing away your money if you work with these people. Stocks and bonds are always fairly priced because everyone has access to the same information as everybody else. Now, what about paying someone to construct a portfolio? This isn't rocket science either. All you really have to do is own 2, maybe 3 index funds, one for bonds, one for stocks, and maybe one for international stocks. Yet, in order to justify you paying Mr. Advisor his 1% fee year after year, he constructs a complicated, redundant portfolio that includes a large cap value ETF, a large cap growth ETF, a mid cap value and a mid cap growth, and a small cap value and a small cap growth. Why do I need all these funds that cancel each other out or simply add more risk? I can own an S&P 500 index fund like SPY. Or if I want to take on a tad more risk by owning mid caps and small caps, I can own a total stock market index fund instead of an S&P 500 index fund. Or instead of owning 50% S&P 500 index and 50% total bond market index, I could own 52% S&P 500 and 48% of the bond index. There, I'm taking on more risk. But you see what Mr. Advisor is doing, he's justifying you paying him 1% per year. If all he did was say, here, invest 50% in SPY and 50% in BND, you'd be like, I can do this myself. What am I paying you for? And then we have some advisors who will say that you should own a natural resources ETF and a real estate ETF. But these asset classes got clobbered in 2008 just like the broad market did. And they're actually more volatile. But again, you want more risk? Why not just allocate more into your S&P 500 index fund instead of bonds? Again, investing is simple. It doesn't have to be complicated. It's the financial services industry that wants you to think that it's complicated so that you'll have to pay them to constantly manage your money, or so that you'll get scared and be resigned to dumping your money into inferior products like annuities, universal life insurance, non-traded REITs, etc.